Have you ever wished you could make bigger moves in the crypto market, even if you don't have a huge amount of money to start with? Many new and experienced traders alike dream of maximizing their potential gains, but feel limited by the size of their own wallets. That's where leverage trading comes in, a powerful tool that lets you punch above your weight in the world of digital assets. With leverage, you can borrow money directly from a crypto exchange, allowing you to control a much larger position than your own cash would normally allow. This means you can potentially multiply your gains even if you start with a small amount. But there's a catch. Because your position is bigger, even small price changes can lead to much larger profits or much bigger losses than you'd see with regular trading. Leverage isn't just for betting on prices going up. You can also use it to profit if you think prices will fall by going short. This flexibility means you can try to make money in both bull and bear markets. In simple terms, you put down a small deposit called margin, and the exchange lends you the rest to open a much bigger trade. This can make your trading more exciting, but also much riskier. Leverage amplifies your potential returns, but it also magnifies your risks. A small mistake can quickly wipe out your investment, so it's not for the faint of heart. For skilled and disciplined traders, leverage trading turns the market into a two-way street, offering more opportunities to profit from both rising and falling prices. But remember, having more power in your hands also means taking on more responsibility. It's easy to get carried away, so always trade with caution. Before you try leverage, make sure you fully understand both the potential rewards and the significant risks involved. Take time to educate yourself and never risk more than you can afford to lose. Leverage is an advanced trading tool. Use it wisely and always respect the risks that come with it. Let's break down how leverage can boost both profits and losses, and why it's such a powerful yet risky tool in trading. Leverage lets you control a much larger position than your initial investment, multiplying both your potential gains and your potential losses. Imagine you have $100 and decide to use 10x leverage to open a $1,000 Bitcoin position. This means you're borrowing extra funds to increase your exposure, aiming for bigger returns. If Bitcoin rises 10%, your position grows by $100, doubling your original money in a single move. That's the power of leverage. It can turn small price changes into significant profits. That's the appeal. Small moves can lead to big gains, making leverage attractive to many traders who want to maximize their returns quickly. But remember, it cuts both ways. If Bitcoin drops 10%, you lose your entire $100 investment just as fast. The same force that amplifies your gains can just as easily wipe you out. The higher the leverage, the less room for error. For example, with 100x leverage, even a 1% drop in price can wipe out your whole position instantly, leaving you with nothing. Leverage is truly a double-edged sword. It can accelerate your gains, but it can also magnify your losses just as quickly, sometimes before you even have time to react. Even minor market moves can have a huge impact on your account balance, especially in volatile markets like crypto, where prices can swing rapidly. That's why risk management is absolutely crucial. Setting stop-loss orders and knowing your limits can help protect you from devastating losses. Never forget, the potential for high rewards always comes with high risk. It's essential to weigh both sides before jumping in. Use leverage carefully, or you could lose everything in a flash. Many traders have learned this lesson the hard way. Always know exactly how much you stand to lose before you trade, and never risk more than you can afford to lose. Smart risk management is the key to surviving and thriving with leverage. To use leverage effectively in trading, it's crucial to understand the concepts of margin and liquidation, as these are the foundation of risk management in leveraged markets. Margin is the amount of your own money you set aside as collateral for a leveraged trade. It acts as a security deposit, allowing you to control a much larger position than your initial investment. By putting up margin, you're essentially borrowing funds from the exchange to amplify your potential gains, but also your potential losses. If the market moves against your position, the exchange may issue a margin call. This is a warning that your collateral is no longer enough to cover your losses, and your position is at risk of being closed. To avoid liquidation, you can add more funds to your margin account or reduce the size of your position. This helps restore your margin level and keeps your trade open. If you don't respond in time, the exchange will automatically liquidate your position to prevent further losses, and you'll lose the margin you put up. The leverage ratio, such as 2x, 5x, or 10x, shows how much your margin is multiplied. For example, with 10x leverage, a $100 margin lets you control a $1,000 position. But remember, higher leverage means higher risk. Even a small price movement in the wrong direction can quickly wipe out your entire investment. If you're new to leverage trading, it's wise to start with low leverage and always keep a close eye on your margin level to avoid unexpected losses. Make sure you fully understand these key terms: margin, margin call, liquidation, and leverage ratio before you begin trading with leverage. Mastering these concepts is essential for protecting your capital and surviving in the fast-paced world of leveraged trading. New to leverage? Start small. Use low leverage and small positions. Always set a stop loss to limit your potential losses automatically. Practice with a demo account before risking real money. Learn how the platform works and how leverage affects your trades. Never trade on impulse. Have a clear plan for entry, exit, and stop loss. Stick to your plan and avoid emotional decisions. Only risk money you can afford to lose. Responsible trading means managing risk, not chasing quick profits. Use leverage as a tool, not a shortcut. Preparation and discipline are your best defenses. Leverage trading is best for experienced traders with strong risk management. If you're new to crypto, focus on learning the basics first. Don't start with leverage. Avoid leverage if you trade emotionally or can't afford to lose your investment. Leverage can magnify profits, but it can also wipe out your funds in seconds. Always use stop-loss orders and understand the risks before you trade. This isn't a shortcut to riches. It's a high-stakes tool for professionals. Be honest about your skills and risk tolerance. Never risk more than you can afford to lose. In crypto, caution is your best friend.